Good afternoon and welcome to the AQUIS Exchange PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. And I'd now like to hand you over to Alistair Haynes, CEO. Good afternoon, sir.
Good afternoon and a warm welcome to all of you. Thank you for joining us for our interim results. I'm Alistair Haynes, the founder and CEO of AQUIS Exchange, and I'm joined here by Richard Fisher, our CFO.
Good afternoon, everyone.
Well, look, I'm absolutely delighted to be delivering a strong set of results, particularly in what I think is a background of very, very difficult market conditions. For those of you who are not familiar with AQUIS, we operate 4 divisions. The AQUIS Markets, which is our lit and dark MTFs, that's the trading of 2,100 stocks across 16 European countries. AQUIS Technologies, which is our cutting edge, developing and licensing the next generation technology for exchanges operating around the globe. The AQUIS Stock Exchange, which is our listings business, and AQUIS Data, which is our market data services. So let's go into the highlights of the results. I think I started off by saying these are difficult market conditions, and I'm really, really pleased that we have grown net revenue by 17% to £9.7 million, and that profit before tax has grown 64% against the same period last year to £1.1 million. Each of the 4 divisions are profitable. Each of the 4 divisions has had double-digit growth during the period. In AQUIS Markets, we promised you that we would diversify the business, and that is exactly what we have done. We've invested in Optimix, we have changed the proprietary trading rule, and I will come into that later on. We've introduced new product during the period. In AQUIS Technologies, we've got a very strong pipeline. What is pleasing, though, is during the period, we had 1 renewal, 1 upgrade, and we expect to have revenue recognition on one of the contracts that we'd previously signed that will be delivering during the second half of this year. In AQUIS Data, we've seen significant growth. I think here the important thing for us is watching what happens in the EU and in the UK regarding the consolidated tape. And with AQUIS Stock Exchange, we have managed to do 5 IPOs in the first half and 2 post-period. I'd like to pass over now to Richard to go through the actual numbers.
Right, thank you, Alistair. Now, as Alistair said, we're pleased to present a strong set of financials for the 6 months to 30th of June. So key factor, net revenue up 17% to 9.7 million. But for me, the key strength here is that all 4 divisions have performed in the period. So we see exchange fees up 14% from 5.4 to 6.1 million. Market data up 34% from 1.4 to 1.8. Technology licensing up 21% from 0.7 to 0.8. And issuer fees up 29% from 0.4 to 0.5. So very much a story of all 4 divisions delivering for us. As we step down through the P&L, I want to just quickly focus on operating costs. So we've seen those increase just by 15% period on period from 6.9 million to 8 million. And there's 3 key factors to that. There's first of all the targeted headcount recruitment that we've had period on period. But secondly, we have seen the inflationary impact come through on staff costs, and thirdly also on our data center costs as those come through on energy costs. So the preponderance of that increase is on the investment we're making in the people that enables us to drive forward. We then step down to the next line, looking at depreciation, amortization and interest. There's actually been a 14% decrease, so dropping from 0.7 million to 0.6 million. And the key reason for that is our interest income has increased period on period. So as you'll note, our cash balances at the period end were 13.9 million. And we've obviously earned interest on those throughout the period. And if we step down through those items, that takes us to the 64% increase in profit before tax that Alistair referenced earlier. so an end PBT for the period of 1.1 million. And I'm pleased to say that we remain on track for our full year expectations. So on that, I'll now hand back to Alistair, and we'll start to do the deep dives into the divisions, looking at, first of all, AQUIS Markets.
Thank you, Richard. Okay, well, the first thing with AQUIS Markets is to note that the actual lit market for the European business is down, not at AQUIS, but is down overall just over 20%. So with that backdrop, to be able to increase revenue is really impressive. For me, that was all down to the diversification of our business. The AQUIS matching pool, which we talked about last year, which was when we purchased the assets of UBS MTF, has grown, is more than doubled since we actually took that business over. We've increased the number of products. We've actually introduced Lit Dark Sweep, and we've made this investment in Optimix. Why? Because we actually are now starting to approach businesses that we haven't had access to before. Optimix is about trading in block size, and that's something that we want to enter, and we've decided to enter it through an investment. But the key change is actually what happened post-period, and that is the change to the proprietary trading rule that we established 8 years ago. During those 8 years, and having introduced the rule, we discovered many changes in the marketplace. What the proprietary trading rule has done is reduce the toxicity available when people are trading. So our liquidity was very different. We don't want to change that. But what we did realize is that banks and brokers, when executing business or wanting to supply liquidity to the system, were not doing so because the time of execution on our market is slower. And that's quite logical, because if you don't have proprietary traders crossing the spread, then it is more likely and easier for you to execute on an alternative exchange. And what we learned over the last few months has been that they prioritize speed of execution way above toxicity. So if we want to grow our business, and we clearly do want to grow our business, we actually want to get the best of both worlds. So what we have done is we've innovated in a unique way, because when liquidity providers supply liquidity, they all do it with different strategies. Some may be about arbitrage, some will be against trading against indices and derivatives, and some will be about things like spread capture. And there's all sorts of mechanisms. The trouble is that most of those market makers do not like to be in the same venue at the same time. Now, what we have done here is by giving these market makers the choice as to whether they can or cannot interact against this flow, and by designing a system that will allow them to give them that choice, we are able to increase that liquidity and at the same time allow brokers and banks who have client business, institutional business, and in the future, hopefully retail business, to be able to come in and have a high speed of execution rather than a low speed of execution. Now, we hope to launch this in Q4 this year. We've already built the technology, and within a matter of a couple of weeks, we will start the customer testing process in a customer test environment. What is this going to do to market share? Well, immediately, we don't see a huge change, because what's necessary is that each bank and broker will need to assess the speeds, they will do their analysis, they will change their smart order routers, and we expect that to take a little time. However, what I do believe is what we have is a unique offering that will substantially over time, in a medium time period, be able to increase our market share very significantly. And that's why we've gone ahead and decided to do this. The feedback we've had so far from almost every client and every market maker is this is a really positive step in the development of AQUIS. If we look at the thing that I've said many times, and those of you who've known me over the years will know that I've had an ambition that we can make AQUIS a top 3 exchange in Europe. In order to do that, we need to achieve 10% market share plus. And I want to show now on this slide exactly how we can do that and why I believe not only can we do that, but we can even be better than that in the long term. Well, if we look at our lit book, which currently is of just under 3%, 2.77%, with the changes we've made to the proprietary trading rule, we believe that that can more than double. So we can attain a lit market share of the whole of Europe at around about north of 5%. If we look at the dark trading, now, when we purchased UBS MTF many years prior to that, UBS already had a 2% market share. When we inherited and bought it, we had it at about 0.3, 0.4%. We've already doubled that to around 0.8%. We can continue to double that, and I'm very confident we can do that. In the periodic auctions, we've got more people signing up almost as we speak. And can we make 1% market share? I'm confident we can do that. And with the closing auction, that product continues to develop and grow. We will get to 2% market share. Each of those numbers are attainable. Each of those numbers, I believe, will be attained within the medium period, and we will get ourselves to a 10% market share, and we will be one of the top 3 exchanges in Europe. Let me pass you over to Richard for AQUIS Technologies.
Oh, thank you. Yes, there's been really good progress year to date in the technologies division. So to pick up, first of all, we've had no churn in the population at all of our contracts, which is great news. So this is everyone is staying with us just as we'd set out. And more than that, what we've actually seen in the period is that we've had one client who's extended their contract with us and another client where they've renewed their contract for a longer term. So those are 2 real positives that we've seen. And that has the impact of actually increasing our average contract length. So across our population, that's now increased to 3.4 years. And if you step that through, what that now means on those contracts alone where we've recognised revenue, there's now a further 9.3 million of cash, which will come through to AQUIS over the lives of those contracts. So that's a real upside to our already strong cash position that we hold. And then as we look forward into the second half of this year, we believe that we will be recognising revenue on one of our existing contracts. So if you remember, we've set out that we have 7 technology contracts at the moment, but we'd only recognised revenue on 5 of those. Of those residual 2, we are now comfortable that we would be recognising revenue in the second half of this year. And then on top of that, we are also in the final stages of negotiation with another client. So it's been a very strong period for us, and we're very pleased with where the pipeline is, but also what we can deliver this year alone. So on that, I'll now, if we turn over to the next slide, I was also going to provide an update as to the data division. And I think here we're again also very pleased with our performance period on period. So revenues are up 34% to 1.8 million, and that's coming through 2 aspects. We've managed to drive up the number of our data licensees, so we're up to 85 now. So strong growth period on period. But we're also seeing the benefit come through of price increases that we previously put through into the data stream. So those have flown through for a full period. And we also note that we are still pricing lower than our main competitors, which gives us potential for future price increases in that space. So a strong story just on that underlying data revenue alone. But I think, as we've often spoken about, the thing that most excites us in this space is the potential for the consolidated tape. And I'm pleased to report that over the last 6 months, we've had a really strong interrelationship with the regulator. So there's been a lot of questions to us about how we see this developing, what it could be. And it's really good that our opinion is not just being sought, but listened to and acted on. So I think we're very pleased with how the last 6 months has progressed. And we still believe and hold to our view that we expressed 6 months ago. This has now become a question of when for the consolidated tape, and it's no longer a question of if. So very pleased to see that progress over the 6 month period. I'm now going to hand back to Alistair to talk to AQSE.
Well, I don't think I have to tell anybody here about how difficult market conditions are in raising capital for businesses right now. This is almost, out of times of living memory, how poor the conditions are. But despite that, we still managed to do 5 IPOs, and actually we've done 2 since the period. We have a compelling offering, and one which is absolutely proportionate and appropriate to allow entrepreneurs to bring their businesses here to get the scale up capital. Unlike our competitors that I think focus on other things like the intermittent trading venues, we're focusing very, very much on where we think the heart of the economy is, which is getting capital to scale up capital to growth businesses. Our ambition here is to be the home of growth companies, and that is exactly what we intend to be. However, this is difficult timing. We're ready for when it happens and when the economy changes, and I believe that we will benefit significantly in the longer term here with the AQUIS Stock Exchange.
Right, and we're now turning to a slide that sets out the key drivers of revenue that we've seen both over time and go forward. And I think the key message to pick up on this is it really shows the dynamism and innovation that we've taken over the preceding periods. So we keep finding new ways to drive new revenue opportunities in each of the 4 divisions. And so even just looking at 2023, we've already spoken about Optimix, our investment we've made there, the rule change that we've brought through. And also we've referenced Equinox, the 24/7 product that we launched earlier in the year in technologies. So each of those drives future revenue opportunities for us. But I think even more so than what we've done in the past, it's what we believe we can do in the future that excites us. And it's the fact that across each of the 4 revenue streams, we see an opportunity set. So ranging from AQUIS Markets, where we believe that we can continue to drive new members, we can continue to push our volumes through much higher levels. Those make a material difference to our AQUIS Markets revenue. If we look in the technology space, we're very excited about what both Equinox and also our developments in the cloud sphere can deliver to us. And then obviously we've just spoken about consolidated tape. There's a material opportunity for us to grow our revenues in that space. So a very strong story, both historically and then looking forward across the near, medium and long term. If we turn to the next slide, this then actually shows how that flows through to the revenue that we've seen over time. And for those of you I've spoken to before, there's 3 messages which I continue to talk to. The first is around our growth. So the chart on the left-hand side, where we show that revenues have increased by 15.7 million or 355% since IPO, since 2018. It's a phenomenal growth story. And we continue to deliver at or beyond expectation each and every year. The second story is one very much around diversification. So at inception, we were very much focused on the AQUIS Markets offering. But as you can see, that by 2022 has now fallen to just 51% of our revenues. And it's that diversification that's enabled us to produce such a strong delivery despite the difficult conditions that we see. So it really demonstrates the success of the strategic delivery we've performed here. And last, and again, apologies, I know I talk to this each time we meet, it's around the nature of our revenues. I think this is probably the one that most excites us. And it's the fact that we not just see 75% of our revenues in 2022 on a recurring basis, it's the other 25% that largely represent our technology contracts. And as I referenced earlier, with our extension and renewal we've seen, those are very much long-term in nature, and we continue to see them grow over time. So a very strong revenue story, both historically and looking forward. I'll now hand back to Alistair to update on our ESG journey and also provide some concluding remarks.
Well, look, we believe in having a strong ESG philosophy. We've not taken our eye off the ball, and environmental, social and governance practices mean a lot to us, and it should mean a lot to all the investors. We took a certification with ESG Mark back in 2021, and I'm really pleased to see the improvement in each area, environmental, social and governance. It really matters for not only our investors, but also for our staff on the changes that we make. Things may sound small, but things like the recycling of food waste, changing our lighting so we had motion sensors to reduce the electricity usage, improving the policies, maternity and paternity benefits, mentoring. We, a few weeks ago, did a volunteering for members of staff who wish to work within the local community. And we're doing a lot more work on how we can actually reduce our carbon footprint. So ESG matters, and it will continue to matter in this company. So in conclusion here, this is a really good start to 2023 in very difficult conditions. As Richard and I both mentioned, to grow double-digit numbers in every one of the divisions is quite an achievement. These are strong results. Our rule change is going to broaden our ability for the total accessible market that we have. If you think of what we're doing here, we used to only be able to participate in a percentage of the market. That percentage will increase significantly with that rule change. It will further increase because what we're doing with Optimark. And we will also look at strategies in the future of things like retail, something which is very close to my heart. There is a huge opportunity in front of us, and our intention to be one of the top 3 European exchanges can be deliverable. In the technologies pipeline, if you asked me 24 months ago, what the type of customer and the type of people we'll be speaking to, I would never have dreamt we're doing what we're doing today. We're talking to governments about national business, national exchanges, operating markets for them. We're talking to national exchanges around the world now. And Equinox has really put us on the map. Not only are we winning or being involved in RFPs, we're getting to the final 2. And in most cases, we're winning. And we're winning against companies who are Goliaths in this game. And we are beating them. The consolidated tape is important to us. Why? Because we don't charge our members today. And the way that a consolidated tape operates means that you are mandated as an exchange or an MTF to give your data to a central tape provider. That is how it works in the United States, and it's how we believe it'll work in Europe and in the UK. The cost of data and the price of data is taken by the consolidated tape provider for the distribution of data to its customers. And from that, the costs of running the consolidated tape are taken away, and the residual is passed back to the exchanges. That means we will get revenue that we have not received in the past because we're mandated to do so. The magnitude of that is hard to tell at this point in time. But what we do know with the basic maths that we look at here and the price of data in the market, it is material for our numbers and would have a significant increase on the data revenues. This is an exciting moment for AQUIS. We've made many changes. We continue to diversify. And I think the opportunity in front of us is huge for us and our investors. And it would be wrong for me not to mention, of course, that we are trading very much in line with expectations. And on that note, I'd like to pass back to our hosts at IMC to open things up for questions.
Alistair, Richard, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, I received a number of questions throughout today's presentation. If I could just hand back to you, Alistair, just to read out those questions and give responses where it is appropriate to do so, I'll pick up from you at the end.
Okay, well, let's start at the top here. Ian S. has said, the number of companies delisting from the London Stock Exchange AIM market is astonishing. Given the compelling offering of AQUIS, what can you do to take advantage of this and give companies a low-cost alternative rather than going private? Well, I think I mentioned in the talk of how important it was that we must keep companies public. And it's why I don't agree with the intermittent trading venue, which is all about private companies using the public market mechanisms to actually maintain and remain private. Our job is to get more equity out there, stop the de-equitization. So I'm completely in agreement with you that if somebody delists from AIM, then we need to try and find a mechanism to come onto AQUIS. The problem is most people who have delisted from AIM are absolutely destroyed by their experience of being on a public market. And I think that's something that we need to get out there in a better way to show that being a public company does not mean that you lose control. It doesn't mean that you have a completely illiquid stock. Doesn't mean that you have to go through. And I know, and that one of the reasons we went into the stock exchange business, the primary markets business, is my experience of going public 5 years ago. It was painful. It took 9 months. It cost £1.3 million. And I'm not certain I get the spreads I want to see in the stock. And we want to change that. Everything we do at AQUIS is about building the next generation exchange. And I think we said at the time, it will take time to make these changes. Unfortunately, in the market, it is designed for a monopoly. And we are here to break that monopoly. I hope we can attract, and we have attracted some, not as many as I would have liked, but these are difficult times. But I reckon we can attract companies coming off and persuade them that being public is hugely beneficial for the entrepreneur who found them and the entrepreneurs who work there. Do you want the next question?
Yes, I can pick up the next one. So thank you. It's from Guy. So the RNS today says a broadly stable proportion of development costs is capitalized every year. What is that proportion roughly? That's a very good question. Yeah, we've previously guided that this is in the sort of 50 to 75% range. The interesting thing here is actually, as we're probably finding, the cutting edge development we're doing, we are able to capitalize perhaps more than we used to. So we're slightly higher in that range, but still within it. But the interesting thing here is that we still amortize those costs over 3 years. We assume a useful economic life of 3 years. I think the reality is that we're actually going to derive economic benefit from this intellectual property we develop over a much longer period. So I think we're being, to use old accounting parlance, very prudent in how we view this. So I hope that sort of helps answer your question there, Guy.
Let me just jump over to Alberto, who's put, given the poor liquidity in the stock, and I agree with you, there is poor liquidity in our stock. Are you planning to move from a quote-driven to an order-driven market to lure retail demand? Well, many of you know, this is something that we have discussed an awful lot. And actually, I am keen to do this. However, we've recently changed our Nomad, and it's a conversation that we'll be having with them about the advice of how we can go forward here. Looking at liquidity in all stocks, not just AQUIS, but also within the AQUIS Stock Exchange, is something that we are really focused on. There are mechanisms that we can use, I believe, that actually can change the way for liquidity provision. And we will look at all these aspects. So yes, it is something we are considering.
And so we've got a question from William I'll pick out. So it's, the technology's revenues seem very second half weighted. Is this due to the timing of renewals or to when projects meet certain milestones? Yes, you are absolutely right, William. And this is, I guess the context, my background is used to be the chief accountant at RBS, and I actually lobbied against a particular standard called IFRS 15 on revenue recognition. But that standard is very prescriptive about when you can recognize revenues on different contracts. So you're absolutely right that the renewal and the extension that I've referenced will drive revenue in the second half of this year. Also, where I referenced that there's one contract where that's now reached a certain point to allow recognition, that will also be a second half event. And the way I'd characterize this is almost, say with that last contract delivery, this is very much when we pass that exchange that we've developed over to the client, and they are now able to access and use that over the life of that contract. So yes, apologies, I think there's a lovely note today that was put out by a broker that's described the accounting as quirky, and that is what drives that lumpiness of revenue. But seeing through the accounting to the fact that these are long-term relationships that drive ongoing revenue is perhaps the key message I'd point to. But a very, very good question. So thank you, William.
There's a couple more here, which Ian S. What does the roadmap look like for new product revenue opportunities? I think people hopefully have realized now we are a very innovative company. I'm not going to tell you all the products that we've got in the pipeline, but I can absolutely assure you there are a number of products that we've got in front of us. Some of the things we've given small hints in page, which talks the key drivers of revenue, the 2024 plus. There are things there that I think can be very, very exciting. And yes, I do believe that there are revenue opportunities. And to David B, who said, congratulations on the results during challenging market conditions. Thank you, David. UK institutions appear to be investing elsewhere rather than in the UK. Do you foresee any government measures to reverse this trend? Now, I am very fortunate to chair the City UK's Business Council. Therefore, I've had access to a number of Parliament and government ministers, as well as policymakers over the last year. The answer is yes, they want to. The challenge is getting it done. And our argument has been very, very clear, which is whilst they may want to favour, or historically favoured, a national market because of the pride in having a national market, you need to look at the United States and say, why are their capital markets so much better than ours? And there are two reasons. The first is you've got competition amongst exchanges that creates innovation on both exchanges. Before NASDAQ came along, NYSE was the effective monopoly. Once Microsoft came into NASDAQ as a small company, the changes that were made over the next 20 years have been quite incredible in that market. And the second thing is, if you go, anybody who travels to America, gets into a taxi, they'll all talk about their 401ks. The appetite for equity from the retail is enormous. We need to get the public back into public markets in the UK. We've got to allow them into IPOs. We need to give them easier access, and we need to make quite certain that they get the professional tools. We are looking at every way that we can work with policymakers to change the rules that today inhibits that. And that is progress I'm very, very confident we can make over the coming months and years.
Right, there's a question from Richard M. Can you define what you mean by data and what it includes? So, yeah, I think probably trying to pick up, this is the sale of data from both AQXE, so the core MTF engine and markets division, and also AQSE. We sell that data from both markets out to external suppliers. So that could be through to a redistributor of that data or directly to data vendors. So it comes through on two routes. I think.
But members don't pay.
Yeah, and I think that's a very good point from Alistair that I neglected this. Our members don't pay for that data. And I think this is one of the reasons why we have our excitement about the potential for consolidated tape. So as opposed to our competitors who will be losing some revenue but may be gaining, we will only be gaining. There is no revenue to be lost for us as we don't charge members at the moment.
And Charles B has said, could an intermittent trading venue offering help build the IPO hopper, albeit restricting an AQUIS intermittent trading venue to the type of companies which AQSE is targeting? It's a really good point, because the current plan invented by the London Stock Exchange for the intermittent trading is really about large companies. And it is about periodic trading, literally a few times a year, where people will have access to providing capital to large companies. We have a very different view. Intermittent trading mustn't be confused with auction trading. We believe that there is the possibility of hybrid trading where you could have some form of auction, some form of continuous trading. And once again, we're investigating all these opportunities right now. The problems are always the regulators have a set of rules which actually prohibit this type of thing right now, but we are pushing very hard to change this so that markets can change and be more market of the future. And I'm absolutely convinced we'll see higher liquidity for small cap and micro cap companies as a result, with better price discovery. So yes, we don't look at intermittent. The ITV is really as described by the London Stock Exchange and mentioned in the Mansion House speech, rather than actually auction and other based trading, which we think could add more value to the micro cap, small cap and mid cap space.
Probably a follow-up question on ITV.
And is that another one there? Right. I mean, Nick H talks about, why do you think that ITV needs to take business away from quoted markets? I think the problem that we've seen for the last 30 years plus is a de-equitization in the market. And what we want to do is get more private companies seeing the benefits of being public. The issue that I have with ITV, and a lot of people disagree with me, but the issue that I have is we need to get young growth companies in the public markets, because if the next generation wants to have wealth creation, they need to invest in what has been the best performing asset class for 150 years, which is a portfolio of small cap and micro cap stocks. If we don't have those equities available, it is going to be extraordinarily difficult for pensions and for these retail players to be able to make money. And I think it's somewhere wrong that we actually can give that money just to large private equity firms, often from other parts of the world, who benefit on the strong performance of the UK economy without giving a chance to the very people of the UK to be able to take advantage of that capital growth. So I don't believe that public market mechanisms should be used to keep private companies private.
I think there's a question here from David B about the proprietary rule change.
I mean, David, that's a great question. Your proprietary rule change, can you explain why some clients favor speed over best price? Well, it confuses me. And to be perfectly honest, it confuses me because when we founded this business and when we brought that rule in, we thought that lower toxicity was of enormous value. And I think it is to certain players. But when you're supplying liquidity, in other words, you get an order and you actually want to be on the bid or the offer. You actually want, and when you're on the bid and offer, to be executed as quickly as you can. And that is the feedback we've had from 99% of the customers out there. It is very, very clear. And the facts are very clear because now we can literally measure down to nanoseconds the speeds that get executed. And these are being done literally in microseconds and nanoseconds. And that difference means something to the end client. We could be very philosophical and say, absolutely, we think it's morally right to look at the best execution in a low toxic environment. But we also need to think about, we should be listening to what our customers say. And the customer demand is clearly there. And the good thing about what the rule change does with the technology that we've created is we've allowed these people to have that choice. And that choice, I think, will make this market really, really exciting. Is share price performance in line with expectations? I don't think I need to answer that. I don't know any founder or CEO who's ever happy with their current stock price. I think I get shot if I say what I think the share price should be, but it certainly shouldn't be here.
Yeah, and there is a question just asking where our expectations are. And I think as with other companies, what we are referring to when we talk expectations is there are external views out in the market that form a consensus, and we are comfortable with where that consensus is. So I hope that helps on that question, David. And I think that's currently our last question that we have. So I don't know if anyone has any further ones that they would like to very swiftly type. I think those of you who've written those in are obviously far quicker at typing than I am. I would still be slowly reaching, but I think we are.
Okay. Yeah, so Alistair, Richard, thank you very much for that. I think I actually managed to address every question from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Alistair, can I just ask you for a few closing comments?
Yeah, look, first of all, thank you all very much indeed for listening to us today. I think we've got a very, very strong track record of always meeting or beating the targets that are set to us. I'm very hopeful for the future. For those of you who are investors, I'd like to thank you for your loyalty and buying shares. For those of you who are potential investors, then I really think the future looks very bright for us. Thank you very much indeed.
Perfect. Alistair, Richard, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of AQUIS Exchange PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.